Today we're covering three things: how market makers actually work, the difference between the two models they run, loan and retainer, and the honest pros and cons of each, and finally, what it costs for a token and what that price depends on. I work at a market making desk, and almost nobody in this industry publishes these numbers, so let me just say them up front. A retainer runs roughly $2,500 to $10,000 a month. A token loan takes 0.5% to 2% of your supply, usually with no monthly fee at all. Those two numbers are not comparable, and the rest of this video is why. Education, not financial advice. Start with what a market maker actually does, because the price only makes sense once you know what you're paying for. A desk sits on both sides of your order book all day, quoting a price to buy and a price to sell. That's it, and it's harder than it sounds. The job is holding the spread tight enough that trading your token doesn't hurt, keeping real size sitting near the price on both sides so somebody can actually fill, and keeping those quotes live across every venue you're listed on, including at 3 in the morning. You're not buying volume and you're not buying a chart. You're buying a book that works. Now, why nobody quotes a price for that? Partly it's legitimate. It's an operation, not a product with a fixed spec, and the cost depends on venues and depth. And partly it's commercial, because a number in public is a number to be negotiated down. Either way, the effect on you is the same. You can't compare quotes if you don't know what normal looks like. Model 1, the retainer, sometimes called a subscription. In a retainer, the project provides all of the capital, both the stablecoin side and the token side. The desk never takes custody of your tokens. They work through API keys on your own exchange accounts, and they manage the book with your money sitting in your accounts. What you're paying the fee for is the operation itself, quoting both sides, managing spread and depth, keeping quotes live across every venue, and holding the conditions that make your token tradable. So the mental model is simple. You own the inventory, you're hiring the operator. Now, the honest version. In favor of the retainer, you keep custody, so your tokens never leave your account. The cost is knowable in advance, which means you can actually put it in a budget. There's no dilution of supply, nothing borrowed against your treasury, and the exit is clean because there's nothing to give back. Against it, you have to fund the liquidity yourself, and that capital is real money doing nothing else. It needs topping up, because under heavy selling, the book absorbs your capital, and if it's not replenished, there's nothing left to quote with. It's also a fixed cost that keeps running whether trading is busy or dead. For a project with treasury but limited supply flexibility, this is usually the cleaner structure. If you don't have the capital to fund a book, it's the harder one. Model 2, the loan. Here, the market maker borrows a percentage of your token supply, typically 0.5% to 2%, and brings their own stablecoin capital to run the book. There's usually no monthly service fee at all. The supply is the payment. Contracts are long, 1 year is standard, and 2 isn't unusual. And at the end, the borrowed tokens come back. That's where the detail founders miss lives. The market maker generally chooses whether to return the tokens themselves or their dollar value. If they borrowed $1 million worth at the start, they can hand back the tokens or hand back $1 million, whichever suits them at that point. That option belongs to the desk, not to you. Pros and cons here too, and be fair to it because there are real advantages. In favor, no monthly fee, so it's accessible to a project that has supply but not much cash. The desk brings their own capital, so you're not funding the book, and your runway isn't touched, which for a pre-revenue project can be the deciding factor. Against it, you're paying in supply, and the true cost is genuinely unknowable at signing because it depends on a price nobody can predict. The contracts are long, so a bad fit is a bad fit for a year or two. The return option sits with them, not you, and there's an assumption worth naming. A lot of founders pick the loan model reasoning that if the desk holds your tokens, surely they want the price to go up. That reasoning does not necessarily hold, and the return optionality is one reason why. Understand the incentives you're signing into in either model. Two things move the price more than anything else, and neither is the one founders expect. It isn't your market cap. First, contract duration. Monthly, quarterly, and annual terms are priced differently, and longer commitments cost less per month. A 1-month engagement carries the highest rate you'll ever pay. If your budget is tight, this is the easiest lever you have. Second, the number of exchanges every venue you add means separate inventory, separate connectivity, separate monitoring, separate quoting. Cost scales with venue count, not with the size of your token, which is also the practical argument for listing strategically instead of broadly. Being well managed on 3 venues usually beats being thin on 8, and it costs you less to do it. So the numbers, again, now that they mean something. Retainer, roughly $2,500 to $10,000 a month, and where you land depends on the duration, the venue count, and the depth you need held. Loan, 0.5% to 2% of supply, usually with no monthly fee, which measured as an equivalent cost, generally works out somewhere in the range of $2,500 to $15,000. But notice what that second range really is. It's an estimate of something that hasn't happened yet. The loan model's real cost is settled at the end of the contract in whichever form the desk chooses, at a price nobody can forecast. It can come out cheaper than a retainer. It can come out considerably more expensive. Here's the mistake I'd most like you to avoid. In a retainer, the fee is not your total cost. You are also funding the liquidity itself, and that allocation is usually larger than the fee. A project that budgets $5,000 a month and nothing else has budgeted for the operator, not for the operation. You need capital in the book plus reserve on top, because a heavy sell wave absorbs what's there and the book needs replenishing. And more broadly, liquidity is an operating cost, not a launch expense. It belongs in your allocation table as its own line, running for as long as the token trades, not stopping the week after listing day. So, which model? There isn't a universally correct answer, but there is a reasonable way to decide. If you have treasury capital and you want a cost you can forecast and an exit you can take, the retainer is usually the cleaner instrument. If you're rich in supply and short on cash and you can live with a long contract and an unknown final cost, the loan does something the retainer can't. What I'd actually suggest is this: ask for both, priced side by side, in writing from the same desk. A firm that can only quote one of them is telling you something about their business, not about yours. And whichever way you go, get the 6 things nailed down. Which model this actually is, how the return is defined, how many venues at what depth, the reporting cadence, the total capital requirement, and the exit terms. The reason this is worth an hour of your time is that it's rarely a one-off purchase. Liquidity runs for as long as your token trades, so a model that doesn't fit is a cost that doesn't fit. Every month for years. Get both quotes, read the return clause, and budget the capital and not just the fee. We're EchoTrade. We've supported more than 2,000 token launches across 90 plus centralized exchanges with 20 plus traders on the desk around the clock. The full written cost guide is linked in the description with every range in this video and the questions to ask before you sign. If you want a straight answer on what your specific setup would cost, the free consultation link is down there too. Subscribe, we break down how crypto markets really work, one piece at a time.